This week on the Wealthy Pilots podcast, let's talk about investing during all-time highs and have Scott give us some information and break it down here on the show. Let's get started.
We've got some turbulence up ahead.
Hey everybody, welcome to the podcast. Thanks for hanging out with Scott and myself as we talk investing, finance, and retirement. A little different setup for me today, bud. The hits keep on coming for me this July. It's been a weird, bad luck month. Broke my monitor like 20 minutes before we jumped on the call, so I had to change my shooting location. But
August is going to be your mark. August is going to be your month.
Mark is going to be my month. All right, there you go. Exactly. You doing all right this week?
Yeah, man. How about you?
Doing pretty good. So is the market. So we're going to talk a little bit about. It set new all-time high records here. Let me pull this up while we're talking at this particular moment. It is at 63.29. And people say the market, by the way, Scott, they're usually referring to advisors, the S&P 500, right?
Yeah, that's probably that's the one I most frequently reference with clients. But, some clients, maybe from older generations will reference the Dow just because it was a little bit more talked about. But the Dow is just a representative of 30 companies. So not super diverse, but it's still a marker out there. And then
I guess you could make the argument that the S&P 500, while it's 500, it's really 7 that drive it. So
yeah, I mean, that magnificent 7 obviously have a huge portion of the capitalization of the market, but and so they can drive a lot of the ups and downs for sure.
Well, the all-time 52-week high is 6336.08 on the S&P 500, and we are currently, while we're talking, 6331.57, so just a teeny tiny little bit below. And I guess I want to talk about a couple of things, and we'll kind of jump into a couple different spots. But if you were panicking in April when it was down, again, this same index was down 12-15%. You are now, hopefully you didn't do anything dumb, right? Anything rash, right? Because here we are. If you click the 1 month out, Scott, it's up 4%. If you click 6 months out, it's up 3.5%. If you go year to date, which would just be this calendar year, right? It's up 7.89%. So hopefully people didn't panic back in August when we were talking about that.
Yeah, I mean, there's a huge benefit to just zooming out. The further you zoom out, the more this thing is just going up and to the right.
Yeah.
And I think maintaining that long-term perspective is super important, regardless of what you have going on. Now, if you have expenses coming up in the next 1, 3, 5 years, maybe that you need to fund, whether that be retirement income or a home purchase or whatever the case is.
Right.
That's not long-term perspective. So don't invest long-term money for short-term purposes. Right. But, if we look at the market and what it's done, long-term, I mean, this year is not even super exceptional. We talked previously about how frequently we see intra, not inter, but within the calendar year, intra-year, corrections of 10% or more. It happens annually on average.
Right.
And so, for the tariff stuff to trigger a 15% sell off like that, the speed of it coming down is, I think, what gets people excited, but or fearful. But candidly, it creates a lot of good buying opportunities, especially when international went on a tear there for a little bit.
Right.
So it lets you rebalance and take advantage of, selling some things while they're high and buying other things while they're low. And ultimately, if you can just, stick with your plan and kind of progress along, the markets are super resilient. But maintaining that long-term perspective is super important. Now, I don't know about you, Mark, but what I frequently hear people say is, hey, I don't want to put money in the market right now because it's at an all-time high. It's really expensive.
Well, I was getting ready to say, it seems like it's the two things. When it's down, they're like, get me out because I'm worried about it falling. And when it's high, it's like, well, it's too high to buy right now. So it's kind of like, pick your poison here, people.
Yeah. I mean, it's why we generally recommend don't try to time the market,
right?
Because you can sit on the sidelines trying to find the right time to buy, and you can miss out on huge returns while you're doing that. But one of the things I think is really interesting from a data perspective, like if you look at, hey, the market exists in one of two conditions every single day. It's either at an all-time high or it's not at an all-time high. It's in one of those two conditions.
Right.
Now, what you can say though, or if you look back historically, regardless of which one of those two conditions it's in, the 1 year, the 3 year, the 5 year, and the 10 year track record of the market after it's either at an all-time high or off is generally the same. It's within a percentage point of each other.
Yeah, what, 7 or 8%, somewhere in that neighborhood usually?
Yeah, if you're at an all-time high, it's hovering around 8. A year later, it's or I'm sorry, if it's at an all-time high, it's hovering around that 8% mark. If it's not at an all-time high, it's hovering at that 9% mark. And it kind of follows that trend. And
well, to your point, sorry not to cut you off, but while we're talking, it literally just jumped up to a brand new record, 63.45.
Yeah. And so, especially when, if you look back and look at bull markets and bear markets, specifically, a bear market historically, lasts about 18 to 30 months.
Right.
That's kind of a very normal range. And so when it's off of its high, you're generally within, about 2 years. Now, the last several bear markets we've have bounced back really, really quick, and maybe that will continue in the future, hopefully.
Right.
But just looking back historically on the average, you're normally within about 2 years of it getting right back up to that high. So again, for the long-term investor, if it's down, that's actually an even better time to buy. But even when it's at its high, we know these things go in bull market and bear market, ups and then downs, and we get in that cyclical nature. Well, the market can get, when it's at an all-time high, can go on a bull market run. 80% of the time, the market exists in an upward trend, 80% of the time. And so even though it's at its all-time high, historically, you got 80% of the time, it's going to continue to go up. And so, that's just one of those things where I think it's really, really not prudent, not wise investment philosophy or policy to say, hey, I'm going to wait until the next crash. Well, I mean, man, you might, if you sat in it from 2018 to 2020, waiting for it to crash, you missed out on all the upward market. And, if you sit on the sidelines and constantly wait around, you miss all that growth. And then you might feel good that, I bought the dip. Well, you bought the dip, it came up here, you were here, and then you bought this dip. Well, you still missed out on all this. You know what I mean? So,
right.
Very.
You think about Warren Buffett, right? So, because what I'm hearing you say is long-term perspective, right? It's kind of like the main key, because what does he say? Don't be in the market for 10 minutes if you can't be in it for 10 years, something like that.
Yeah.
Right? Because it is a longer-term trajectory. Because if you are reacting to just highs and lows, you're missing the fundamentals, I suppose.
Well, and if you're not getting ready to retire very soon, it's like just keep buying.
Yeah.
Just keep, have the discipline of investing versus trying to, time the market or double your money or whatever. It reminds me a little bit of like, I don't know if you've met anybody who is moving their money around different banks because, I'm at 3.8% APY here, and then some other bank opened up and they're at 3.94. So I'm moving my money over there now. And it's like, you're not giving the money time to compound anyways, and you're just chasing things and you're disrupting it all the time.
Yeah, it feels like the cell phone shell game where it's like, I'm going to leave this company and go to this company for a while because they're going to give me these discounts for a year and a free phone. And then a year later you want to, and it's like, it's more trouble than it's worth, more hassle than it's worth.
Yeah, and generally speaking, the folks that are just bought into the market and they're continuing to buy, specifically, they're doing some strategic rebalancing in times of volatility. They're going to be the ones that are outperforming long term, and maybe not outperforming a given market index that you're tracking. I'm not sure, but outperforming their peers that are trying to time the market and take some either risk by trying to time it, or they're taking unnecessary risk by sitting on the sidelines, and not compounding their
well, so we're going to keep this one short and sweet this week. So what's your 3 key takeaways to investing during an all-time high? What's 3 things for people to think about?
I think the key piece is like, follow your plan. Like, you should have a plan of like, you're saving X amount per month. It's those investments are going in and doing some sort of rebalancing your account every month. So, follow your plan. Don't deviate the plan just because the market's at an all-time high.
You got some strategy. Okay.
Right.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own financial flight control toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
The second point that I would leave you with is that it generally doesn't matter if it's at an all-time high or not. Again, if you take a snapshot in time where I'm at today and then fast forward 3, 5, 10 years later and then look back, there's going to be ups and downs, but you're very likely to be in a higher spot in that time frame than where you are today. So just keep buying. And then the third thing I'll say is that take that opportunity. If you're feeling any, sense of like, oh, market's too high, it's too expensive, zoom out, look at a market chart from 20, 30, 50, 100 years. And again, the further you zoom out and get away from the headlines and get away from trying to live in the market day to day, you just see this thing's going up and to the right.
Yeah.
That's the long-term trend. I don't think that's going to change. That's my belief. That's the optimism that we're going to live in. But that optimism is rooted in 200 years of reality. And I think, letting yourself get swayed off of that is getting rooted in some sense of delusion from something you're reading, something you're watching, or whatever. So zoom out, keep that long-term perspective, and your patience will pay off. And
I get that when your time horizon is getting shorter, it's harder to sometimes kind of feel that way. But again, that's where the strategy comes back into play to help you not overreact in those different kind of highs and valleys and peaks and so on and so forth. So as always, if you need some help, get on the calendar with Scott. Reach out to him at retireairlines.com. That's retireairlines.com. He is the airline advisor with Patriot Wealth Planners. And of course, they're here to help you with your strategy getting to and through retirement. So reach out to them. Don't forget to subscribe to us on Apple, Spotify, and YouTube. Links are below. And we will see you next time here on the show. Thanks, Scott. Appreciate it, brother.
Cheers.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.